All right, I'd like to call to order the meeting of the Food Services Employee Pension Board meeting. Let's start by taking roll for the board members if we can. This is Jim Hendrickson speaking. Frank Nash is out this evening, so I will cover the meeting for him.
Charles Piro, Bob Raleigh,
Jared Schmidt.
Britt Murdoch from Callan.
Kevin Schmidt from Callan.
Dave Kramer.
And Chitsmay Lamb.
All right, thank you. Do we have any comments from the public before we get started? Okay, none seen. We will move on to two pensions. If we could Sharon on.
No.
Not yet. Yeah, let's do the notes. We'll do the notes first. So we have the minutes posted from the June 12th meeting. There are any comments on those? No comments? Have a motion to approve the minutes?
Okay, wants to improve it, approve.
Mr. Kramer approves. Okay, Mr. Valerie seconds, the motion's passed. Okay, we have two pensions. I guess we'll go through these. I think these were discussed at the prior meeting to postpone. The first one is for Paula Rossi, who is requesting a pension after 5.5 years of employment. Does anybody have any questions on that? She took a deferred retirement and she's requesting the standard form pension. 5 years certain. Any questions on this?
Not, we'll move separately.
We'll go together. We will note for the minutes that Mr. Baskin has just joined the meeting. Okay, the second pension is Virginia Marco. Worked for the city for 19 years. Is applying for early retirement. And is taking option 3, which is a 10-year certain pension payout. Anyone have any comments on that? Been reviewed?
No, as I said, I didn't see any problems with either one, so I moved through both.
Second for that?
I'll second that.
All in favor?
Aye.
Okay. Unless there's any further discussion, would ask for a move to adjourn your employee service meeting. Okay, second. Mr. Baskin seconds. Okay. All right, I'd like to call to order the meeting of the regular pension board. Again, we will note the roll call if we could. This is Jim Hendrickson.
Charles Piro, Bob Raleigh,
Rich Baskin. Jared Schmidt.
Britt Murdoch from Callan.
Kevin Schmidt, Callan.
Dave Kramer.
Chitsmay Lamb.
Okay. Are there any comments from the public? None noted. Let's review of the minutes. These are from the October 8th meeting. Anybody have any comments on these? No comments?
No comments.
Motion to approve, please.
Motion to approve.
Second. All in favor?
Aye.
Okay. We have a couple of pensions to review. The first one is Patricia Wooten. 27 years of service, worked in the tax assessor office. He is requesting a normal retirement with standard form option, 5 years certain payment. Anyone have any questions on this?
I did not know.
Any questions? Any comments? Motion to approve?
So moved.
So moved. Second?
Second?
Second, all in favor, aye?
Aye.
Okay. The next one is Katie Johnson, who worked for 39 years for the city. Not sure what ROV is, but she was.
She only gets 35 years of credit.
Right.
Yeah.
Apparently, yeah. Administrative supervisor. And beneficiaries all look in order. She's requesting option 3, which is a 10-year statement payment. Any questions on that one?
Okay, I move to approve.
We have a second?
I'll second
All in favor?
it. Aye.
Aye. All right, the pensions have been approved. We are now going to go into executive session to discuss the small cap manager selection process.
Can you pause the recording?
Okay. Okay, we're back in session. We've had discussion about small cap growth managers and, do we have a, motion on a selection here?
We transfer funds to Emerald. Where does the money come from?
Principal,
right? I'm sorry.
Principal.
Principal to Emerald.
So the motion was to move $25 million approximately from principal to Emerald. Do you have a second to that?
Close out principal.
And close the account.
I'll second that.
Correct. We have a second on that motion?
second that.
Second, all in favor?
Aye.
Aye.
All right, thank you. Okay, next on to performance review. Britt or Kevin, you're on deck.
Okay, I'm gonna go through the October report. So just starting at the macro level, we saw a really kind of continuation of the strong run we've had. This is in October. Technology stocks again were the main driver, and that was, kind of a global theme, not just here in the US. So we saw MSCI emerging markets actually lead the way for the month. They had a return of 4.2%, really strong support from both Taiwan and South Korean equity markets. S&P 500 gained 2.3% in October, and that was on the heels of another really strong earnings season, particularly within the technology sector. MSCI EAFE was lower at 1.2%. Really the issue there though was that the stronger US dollar diminished the performance, so they lagged the other two. On the fixed income side of things, we did see those markets kind of hold their ground. There were some high profile corporate bankruptcies, which we've talked about at prior meetings that occurred during the month, and as well as some kind of dampening in terms of the sentiment around the Fed and what's going to happen with the rate cut that just happened a couple hours ago. So if you recall back in October, the Fed came out, the chair, Jerome Powell, and said that any rate cut in December was not a foregone conclusion. And the market, the fixed income market, reacted pretty negatively to that, I would say. A lot of people were surprised because they had already priced in an additional rate cut. We know sitting here now that it did come to fruition after all of that, but there still remains a lot of cloud, let's say, on the go forward. And I think it was a 9-3 vote, if I'm not mistaken, a few hours ago, and they said something like we haven't had that in 6 years in terms of like the 3 dissenters. So will be interesting path forward to see what happens. Taking a look at the report, just on page 1, fund grew by about 3 million on a net basis when taking into account the cash flows that were needed for benefit payments. And then, going to page 2, we could see that when we look at the asset allocation, all of the asset classes continue to add value on an absolute basis for the fiscal year to date. However, relative performance has been mixed. Some areas like domestic value equity, international equity, continuing to struggle, and I think we talked about this at the last meeting, but there are some market dynamics going on. Britt mentioned this, anybody with like a quality bias has really gotten hurt, and that's just kind of continued to play out here, unfortunately. Looking at a few of the managers, LSV, so year to date through October 31st, the portfolio was up about 0.5% versus 9.3% for the Russell 2000 value, and 12.4% for Russell 2000. What's interesting in kind of reading through some of the LSV research is that the S&P 600 value, so that's another proxy that's used for small cap value stocks, that was only up 2.8%. So again, the Russell 2000 value 9.3, and so it's like, well, what's the difference? So the Russell 2000 value, they have a much higher exposure to negative earnings companies than S&P 600 value. It's just, again, kind of considered a higher quality index. And really S&P 600 is going to be more where LSV plays as a manager. They're not going to be invested in a lot of these negative earning companies, which is why you see them at 0.5% return versus, again, 9.3 for the Russell 2000 value. So they've suffered, as a result of these negative earners having been the best performing part of the small cap index this year, just because they don't have that exposure. So they're relying on their longer term numbers, which still look decent when you take a look at like 5 years, and kind of, I don't want to say banking, but banking, for lack of a better term, the fact that this junk rally is going to be more short term and not some sort of like long-term cycle that's happening in that marketplace. And this does occur from time to time. So it's certainly not the first time we've gone through this. On the international side, Walter Scott, again, they have suffered for similar kind of quality reasons. I think touched upon this briefly at the last meeting, but they have been absent a fair amount of the banks as well as defense companies. And those are a couple of areas that have done particularly well in Europe. And so, they've met with banks, they've met with these defense companies. On the defense company side, they just don't think it's sustainable, frankly, in terms of, relying on the government of Germany or whoever to continue to pump money into defense spending, particularly when you're part of like, socialist societies that where social benefits are, if somebody has within that country is saying, would I rather you spend my money on my personal benefits or, defense spending, I think we know it's going to probably win out. So they don't see that as being sustainable. And then on the bank side, they a lot of the share price gains there reflect valuation re-ratings as opposed to earnings growth. And so similar, they don't think that that's a long-term trend. So they feel comfortable where they're at, even though they've suffered in the short term.
How long have we been with them? 3 years?
Not even, I don't think, right? So,
Close to 3.
yeah,
I'd say.
And they've been in once?
but
They were in
yeah,
early
couple
last
times.
year, I believe, and we wanted to have them in either January or February.
Yeah, let's do
I think the other manager, if they want to have it as EBS,
that. Mm-hmm.
given their write-off last month.
One thing to note too, and I think Britt sent an email to everybody about this, is that they did announce a fee reduction for the strategy. So they were going from 75 basis points to 65 basis points, and that'll go into effect January 1 next year. I think that's a little bit of self-reflection on their part. Yeah.
Blow the float out the door.
Yeah, well, we always say like the quickest way to turn around performance is to reduce fees. So, we don't want that. We just talked about not being a
It's not
long-term
a-
strategy.
it's not
That's
gonna-
not a long-term strategy,
Right.
but we'll certainly,
Help.
yeah.
And their process is really struggling across their strategies. It's not just their developed international growth strategy that's in this portfolio. It's really their process and their philosophy have simply been out of favor, and they're not being rewarded for the quality at a reasonable price and sustained earnings growth that they expect. But you know, I don't think some of these markets, to Kevin's point, are sustainable over longer periods.
Maybe I'll just maybe quickly touch on PIMCO all asset. So on the positive side of things, some of their positions in EM equities contributed to performance. As I mentioned earlier, that market was up over 4% for the month. And in part, you know, the weaker dollar and continued AI tech rally there. The flip side, they did have positions within REITs and MLPs detract from performance, but not enough to offset you know, the strong performance that they had. And you can see on a 1 year basis now, they're up a little over 14% versus, depending on which benchmark you want to pick, either, you know, 6.8 or a little over 8. So that's been a nice contributor to overall returns in the more recent time periods. Yeah, questions on anything?
You good for cash right now, Chisholm?
Yeah.
Okay.
Is there any preference on manager to present in January?
Well, if you look at the first quarter, I guess we'd want to have Walter Scott in, right?
Yep.
UBS, I guess, you know, we should hear from them, but I think they've learned their lesson, right? But yeah. We always, you know, as you know, I've always liked those guys and their performance because they're steady eddies and they're always 6-8%. So is there, what do you guys think? Is there benefit having them come in and tell their sad story?
Well, I would frame it more as, okay, you've had, for whenever we bring them in, you've had 4 months, 6 months. What concrete changes have you made now as a result? You know, what have you learned? And because there were clearly issues with, you know, the risk management side of things. I'm sure Rich would be happy to browbeat them for a few on what's, you know, again, like but Britt and I talked to them.
Not credit risk.
We talked to them very shortly thereafter, you know, things went awry. And you know, they're everybody understands at that point, like something's got to change. But if you give them a few months now and say, okay, like what have you actually done? Like, how are you going to make us feel better about the path forward?
So maybe we have Walter Scott and we can have UBS in at some point.
Yeah.
Yeah, okay. 2 in the first quarter now?
Yeah.
I think so. Okay. All right. Any other questions? Anybody on performance still? You distributed the OPEB and DC stuff as well. Do you want to cover that or not in this meeting? We don't have a meeting with that for a while.
We can certainly cover it.
Well, we should save this for those meetings, I guess. What do you guys want to hear it?
Well, in the starting the next.
We got DC in January, defined contribution in January, OPEB in February, so I think we can hold.
Yeah, the OPEB, I mean.
I don't think there's anything wrong with reporting on it. There's no action being taken.
Right, okay,
So-
that's fine.
Yeah,
All right, let's go to that.
there's some underperformance in DC, but OPEB is steady Eddie. Do you want to?
Yeah, let's do a quick review of both, I guess.
Why don't I start with OPEB?
Okay.
So this is the third quarter report. You have the PDF open.
Page 22.
Yeah, maybe I'll start on page 20 of the PDF, showing the asset allocation versus target. Overweight to domestic equity, just given the run-up of US markets, pretty in line with international equity and slight underweight to fixed income and in line with target on real assets. On 21 assets up to about 160 million. And then on 23, showing performance. Given the larger allocation to equity here, you know, the plan's done very well. up 6.4% for the quarter. Outperformance largely being driven by fixed income managers as well as PIMCO. So the OPEP continues to do really well.
Simple but really good.
DC,
Yeah, I mean, you get, right, your beta across the equity side, so.
which has been the best trade.
Yeah, right, we index, if you've been indexed over the last 10+ years, they've been a winner, so it's.
And then on the DC report, I'll start on 26. 418 plan assets, about 28 million, which is pretty amazing. I think when I started working with this plan, it was under 1 million.
Yeah.
So it continues to grow as employees use it as their main source of retirement saving. On page 27, you can see the target date funds. About 87%, which we view favorably.
Yeah.
It's the default for participants. And on 29, you can see most contributions also going to the target date funds. And we think those are most suitable for participants.
There was an article in the Journal, I think it was a couple of weeks ago, about how some managers are trying to start to slip in some, private equity and some other type of
There-
assets in these target dates. Are we seeing any of that from our manager?
They're all frothing at it, so they, it's happened, there are plans, there are corporate plans, some very large corporate plans that have private market assets. Traditionally, it's been more real estate, but you're starting to see some of them introduce private credit now as well. No, none of our clients to date have done it. There's a lot of fiduciary risk that comes with that naturally. I will say, I do think it is coming, particularly with the current administration, kind of being more favorable to that. And so what's happened is,
Well,
there's
going public, so.
there's like 5 or 6 main target date fund vendors out there, and some of the largest private market asset managers have paired up with them, and so they're going to step in, and they're all kind of saying the same thing, that they're targeting like 15% of a target date fund, like a vintage, to have some combination of most likely private credit, real estate, private equity. The illiquidity there is a little trickier. And then they're already talking to like Callan about what that liquidity, it'll be like a 30-day, gate, if you will, and then kind of like a max in terms of how much you can contribute or take out any given month. Again, they're frothing at the idea that like that's where all the growth is happening. Like, public pension plans, corporate pension plans are somewhat a thing of the past at this point, by and large. And so they just see all the asset growth there.
When this happens, are they putting him in mutual funds?
Not yet.
No, it's like a CIT. No,
Most of what we see,
Yeah.
I have one very large corporate client that does have private equity in their life.
oh, they do. Okay.
To Kevin's point, private real estate, Callan, we have our own custom target date funds. We've had private real estate in our target date funds for 10+ years. But where this is really coming from is President issued an executive order to the DOL to review and provide guidance in private markets and 401k or defined contribution plans. I think the DOL had 60 or 90 days or whatever it was, but that was before the government shutdown. So I think it remains to be seen on what comes of this. To Kevin's point, I think if the DOL does issue guidance in favor of the inclusion of private markets assets, I don't see it going away from administration to administration because it's too difficult to pivot. But I think the hard part I personally have is, what's broken that we're trying to fix by adding higher fee components, and can you make it a large enough piece of the allocation?
Other than the industry earnings.
Well, that's just it. It'll become, the returns will get muted. it'll become a diversifier, like an expensive diversifier at the end of the day. And then what happens when we have a liquidity event at some point, right? And what's the knock-on effect for LPs, like yourselves on the institutional side, with all this new money chasing deals, will the retail market get more favorable terms?
Yep.
Yada, yada, yada. So there's
We put out a webinar,
yeah.
which is pretty interesting because it takes a very tepid stance on what it could look like and what has worked in the past. We're happy to forward it along to the board. But we are seeing providers create these
Okay.
target date funds, and it's certainly the hot topic of the DC industry right
I
now.
mean, does it change the risk profile of a target date fund dramatically? And do we have guidelines ourselves in terms of, what risk profile we want to offer in terms of, within our target date funds?
It doesn't really, again, like in some ways it actually benefits it because by adding an uncorrelated like asset class or two,
Diversifies it better.
yeah, it actually diversifies it better. The greatest change will be to the overall fee.
And I think depending on what projections you're using or assumptions you're using in, forward-looking projections with these new asset classes, I think, the model has to work so it doesn't all go into one asset class. And, I'd take it with a grain of salt. I think the providers would tell you, oh, look at this, we're improving return and lowering risk. And is that reality? I don't know.
Yeah. When do we have a power in on this thing for next year?
Even like timeframes too, like target date
Have
fund,
them at one of
which
the-
target date fund
Yeah, right.
timeframe.
Well,
It'd
right.
be a good topic for them to talk about, I guess,
And-
are they hearing about
We
it?
can bring Capital Group in.
Yeah, I would say ours is probably might be less, Empower is maybe a little bit more of a incentivized to,
Yeah,
right? Like we're kind of,
yeah, okay.
we don't get any
We'll
benefit.
forward everyone
Yeah,
our webinar.
To
Interesting
David's
topic.
point that he asked about like the different vintages, I mean, yeah, it wouldn't go into like those close to
10
retirement.
years,
I
5
mean,
years from go, but
You could say that there's an argument to be made that the liabilities of like are actually a good match for younger investors, right, in retirement assets.
Yeah, if you're 25 years out.
Yeah, but I think what you don't have to ever worry about is it being a standalone, like on the core
Yeah.
menu, like that would just be a nightmare. So at most, it's only gonna ever live in a target date fund.
Okay, all right. Thank you.
And they won't add it to like Norwalk's
Yeah,
mutual fund series. It would be a whole new
Yeah. something else,
series
Yeah,
right.
that clients wouldn't have to actively elect to go into.
Yeah. Okay.
sounds a good idea, right? That was a bad idea.
Right.
Could be.
Okay, next item we had on the agenda was review of and approval of the schedule for the year. Everyone this was distributed. Anybody have any questions or comments on it?
No, look pretty straightforward.
Sorry,
It looked pretty straightforward to me.
motion to approve it? All set? Second? I'm sure we need to approve it, but we would. Okay. All right, motion is approved. The next item on the agenda was a discussion of a particular pension appeal. But we have not yet confirmed we have.
We should go into executive session. I can tell you what I know and then.
Okay, yeah, we're gonna go do executive session for it. Okay, we are back in session. One of the items on the agenda tonight was a request for an appeal by a prior employee regarding the start date on his pension benefits. The board has discussed this and we have previously reviewed this, including with outside counsel. And at that time confirmed that we were rejecting the request. We see no new information here to indicate a different decision should be made at this time. And we will ask that the HR department send the previous employee a letter confirming that.
Good.
Okay, all right. All right.
Any other items to discuss tonight? No?
Move to adjourn.
Move to adjourn, second,
Second.
all in favor?
Aye.
Everybody. All right, let's see what happens next.